Gold and silver are plummeting in an uncontrolled descent right now. This isn't a gradual decline, a minor retracement, or a period of consolidation. This is a full-blown freefall. As I record this, gold has just breached 4,600. Silver sits at 72. With every refresh of my screen, the figures sink lower. 45.50, 45.20. There is no pause, no halt. What we are witnessing has moved beyond a mere correction. This is a live market crash unfolding in real time, a collapse that is progressing as you watch this very video. Friday was presumed to be the climax. A 38% plunge for silver, a 16% drop for gold, marking the most severe single trading day in 45 years. The consensus was that it was over. Everyone believed the selling pressure was spent. Everyone was convinced the floor had been found. What we are seeing now is pure, forced liquidation, a chain reaction of margin calls ripping through the financial system. Traders are being obliterated, one position at a time, one account after another, and the velocity is increasing, not diminishing. It is accelerating. Welcome to the hidden economy. If you are new to this channel, I uncover the true dynamics of markets while others remain preoccupied with surface-level headlines. Subscribe immediately because this is the caliber of insight you simply cannot access elsewhere. If this video provides you value, please hit the like button emphatically. It assists the algorithm in promoting this content to a wider audience who truly needs to see it. Now, in my previous analysis, I pinpointed the precise level of 117 and detailed exactly why silver plummeted from that point. At the time, skeptics in the comments were pointing to rallies to 118, 120. Regardless, before I present the data, understand this. When markets opened this morning, thousands of traders attempted to offload their silver ETF holdings. Their sell orders were rejected. Circuit breakers were triggered. Friday's collapse was so extreme that current prices remain beneath the exchange's circuit limits. The trading platform is refusing to accept sell orders. Individuals who held positions over the weekend, hoping to exit on Monday morning, are now ensnared. They cannot liquidate at any price. The system itself is preventing them. This is occurring right now, simultaneous with gold breaking below 4,500 and silver crashing through 72. This video will elucidate the reasons behind this event, and crucially, how you can ensure it does not happen to you. Here is the root cause. The mechanism is known as a margin hike. When you engage in futures trading, you post a deposit, typically about 10% of the contract's value. So to control $100,000 worth of silver, you put down $10,000. That is your margin, your financial commitment. If the exchange decides overnight to increase margin requirements, you are suddenly required to furnish more cash. Not next week, not when your bank transfer finalizes, immediately. If you lack the ready capital, your position is liquidated automatically. The exchange sells you out at whatever price the market offers at that exact instant. And when a multitude of participants are being liquidated simultaneously, that price is catastrophic. The absolute lowest point, the most unfavorable exit imaginable. A single margin hike is manageable. Most seasoned traders maintain a cash buffer for precisely this scenario. But what occurs when there are 2 hikes, 3, 4? What if there are 8 consecutive margin increases over 8 weeks? That is not survivable. That is extermination. And that is precisely what the CME executed. 8 margin hikes in 8 weeks, each one engineered to extract more capital from those holding long positions, each one tightening the vice. Throughout December and January, they pummeled traders with hike after hike. A hike on Christmas Day, a hike over the New Year's weekend. Every time traders regained their footing, another hike arrived. Then came the decisive blow. On January 13th, the CME transitioned to percentage-based margins. Now, as the price of silver rises, your required margin increases automatically, a self-tightening trap. The higher silver climbs, the more cash you must produce, even if you take no action. And they did not relent after Friday's massacre. Monday morning ushered in another hike, then another this week, 8 in total. For perspective, the entirety of 2024 saw only 2 hikes. 2023 witnessed 3, 2022 had 2, 7 increases over 3 years was the historical norm. 8 hikes in 8 weeks is an event without precedent. I have scrutinized 2 decades of CME data. This is uncharted territory. Each hike incites forced selling. Forced selling drives prices lower. Declining prices trigger margin calls for other traders who weren't initially impacted by the hike. This leads to more forced selling, further price depreciation, a deliberately engineered death spiral. That very death spiral is what you are observing on your screen right now. Gold at 4,500, silver at 72 and continuing to fall. But here is the element that kept me awake last night. This morning, on the very same day as the CME's hike, the Shanghai Gold Exchange also raised margins between 20% and 26%. The CME in Chicago and the exchange in Shanghai, China, separated by 14 time zones, took identical action on the same day in the same direction. America and China, 2 nations that concur on virtually nothing, locked in trade wars, exchanging sanctions, debating at every international forum, are suddenly moving in perfect synchronization on silver margins. This is not supposed to happen unless both are alarmed by the same imminent threat. And I believe I know what that threat is. 356 to 1. That is the current paper-to-physical silver ratio on the COMEX. For every single ounce of actual metal residing in the vault, there exist 356 paper claims on that ounce, 1 real ounce. 356 paper promises. This system functions only as long as all settlements occur in cash. But when entities begin demanding physical delivery, the arithmetic disintegrates. And right now, people are demanding physical delivery. In the 3rd week of January, 33 million ounces of silver were physically removed from COMEX vaults, not traded, physically withdrawn, loaded onto trucks, and gone. That represents 26% of their total inventory in one single week. 4 years ago, COMEX held 430 million ounces. Today, that figure stands at 113 million. 74% has disappeared and the pace of outflow is accelerating. The 1st week of January saw 7 million ounces depart. The 3rd week, 33 million. This is not an exit. It is a stampede. Who is taking possession of this silver? Not retail investors. Moving 33 million ounces necessitates logistics, security, and warehouse coordination. This is institutional capital. Manufacturers, sovereign wealth funds, sophisticated money. They are draining the vault and they aim to do so before March. Here is why March is critical, and you must understand this. March futures contracts represent 528 million ounces of promised silver delivery. That is the total amount of silver obligated to traders holding those March contracts. The vault contains 113 million ounces. Read those numbers once more. 528 million ounces promised, 113 million ounces available. They have pledged to deliver nearly 5 times more silver than physically exists within the entire COMEX warehouse network. First notice day is March 27th. This is when every holder of a March contract must declare their intent, cash settlement or physical delivery. If merely 22% of contract holders demand physical metal, the vault will be completely emptied. Not strained, not tight, empty. What transpires when the 23rd percentile arrives to claim their silver? This is the nightmare scenario the CME and Shanghai exchanges are desperately trying to avert. This is the reason we are observing coordinated margin hikes. They must force out the long positions before delivery demands expose the systemic shortfall. And it is working. Look at your screen. Gold at 4,500, silver at 72. Long holders are being systematically eliminated. But here is the incontrovertible evidence, the smoking gun that reveals this is not an organic crash, it is manufactured. Pull up two prices right now as you watch. COMEX silver, the paper price, the figure displayed on financial networks, $72 and falling. Now look up Shanghai silver, the physical price, the price where tangible metal actually changes hands, $100. Identical commodity, same day, same planet, a $28 disparity. You need to comprehend the sheer insanity of this. Paper silver in New York trades at $72. Physical silver in Shanghai trades at $100. That is a $28 gulf. This means physical metal commands a 39% premium over paper. If silver were genuinely worth only $72, why would any rational entity in Shanghai pay $100? Why would sophisticated Chinese buyers, manufacturers who require this metal for production, willingly pay 39% more than necessary? They wouldn't, unless they possess insider knowledge. They know the paper price is artificial. They know $72 is a manipulated figure. They know the true value of silver aligns more closely with what they are paying, $100. And here is what should truly astonish you. The gap is not narrowing. On Friday, the divergence was $25. On Monday, it widened to $30. Today, even as COMEX crashes further, the gap holds firm at $28. Shanghai is not collapsing in tandem with New York. Physical metal is holding its value while paper contracts implode. Consider the implication. If this were a legitimate crash, driven by authentic supply and demand fundamentals, both markets would decline together. Paper and physical would move in unison. They are not. Paper is in freefall. Physical is steadfast. That revelation tells you everything. The paper price is being artificially suppressed. The physical price is reflecting reality. One of these prices is a fabrication, and I am confident I know which one. Now, consider who benefits from this fabrication. J.P. Morgan holds the largest short position on silver in banking history, a stance maintained for over a decade. For every dollar silver falls, they reap hundreds of millions in profit. Bank of America maintains massive short positions. HSBC holds massive short positions. These very institutions have representatives on CME committees. They possess visibility into market positioning. They know precisely where the pressure points lie. On Friday, while regular traders suffered a 38% loss, these banks earned billions. Today, as gold crashes through 4,500 and silver through 72, they are earning billions more. I am not alleging criminal activity. Short selling is legal. Serving on exchange committees is legal. I am merely highlighting that the entities profiting most profoundly from this crash are the identical entities wielding the greatest influence over exchange policy. You may draw your own conclusions. The timing of last week's events is also significant. On Thursday evening, Reuters published a story citing anonymous sources, claiming the U.S. government was ending support for strategic metals. Algorithms triggered selling, and a cascade began. 3 hours later, the Energy Department issued a statement. The article is false and relies on sources that are misinformed or deliberately misleading. False, completely fabricated, yet the markets had already crashed. Algorithmic systems do not reverse for corrections. Also on Thursday night, a leak emerged regarding the nomination of a hawkish Federal Reserve chair, negative for metals. The official announcement came Friday morning. Insiders knew Thursday night. Fake news, leaked nominations, 8 margin hikes, all converging within the same narrow window. Coincidence? Here is another discovery from this morning that no one is reporting. The day before the crash, on Thursday, there was highly unusual options activity on silver ETFs. Massive put buying. Someone placed enormous bets that silver would collapse the day before it happened. Either someone possessed extraordinary luck, or someone had foreknowledge. Now consider what happened to the traders who tried to escape. They couldn't. In China, the UBS SDIC Silver Fund was completely halted. Not slowed, not restricted, fully suspended. For the entire trading session, 0 trades were executed. No buying, no selling, nothing. Imagine witnessing silver crash 30% and being incapable of selling. Clicking the sell button with no response. Refreshing the page repeatedly, only to see your net worth evaporate minute by minute while the exit remains locked. This was the reality for thousands of Chinese investors. In the United States, the ProShares Ultra Silver Fund dropped 62%. If you held $100,000 on Thursday night, you were left with $38,000 by Friday evening, 62% of your capital obliterated in a single session. The iShares Silver Trust plummeted 31%, its worst day since inception. Yet the price declines were not even the most severe aspect. Traders attempted to sell. Orders were rejected. Platforms displayed error messages. Systems overloaded. Customer service phone lines had wait times exceeding 2 hours. And when callers finally got through, they were told nothing could be done. One trader messaged me, describing his 18-hour ordeal trying to close a futures position. Every single sell order was rejected. He watched his account drain, dollar by dollar, thousand by thousand, with zero ability to intervene. As of last night, some traders still reported account access issues. Days later, unable to view balances, unable to execute trades, still locked out. They crashed the price, then they blocked the exits, then they raised margins again. Contemplate that sequence. Crash, lock, raise. If you were architecting a system to annihilate long positions and transfer wealth from retail traders to institutional shorts, this is precisely the blueprint you would follow. Now, examine the fundamental backdrop that renders this crash utterly illogical. It makes no fundamental sense whatsoever. Silver has been in a supply deficit for 5 consecutive years. Solar panel production requires it. Electric vehicles need it. AI semiconductor manufacturing depends on it. iPhones utilize it. Demand is exploding. Mine supply is stagnant. The cumulative shortfall since 2019 totals 1.3 billion ounces, equivalent to 18 months of global production, already consumed. And then, China locked the door. Effective January 1st, 2026, silver was added to China's strategic materials list, requiring export licenses. Export volumes have subsequently fallen 40%. China refines approximately 65% of the world's silver. They have essentially informed the West to find another supplier. There is no other supplier. This crash is inflicting damage far beyond traders. Businesses worldwide are being devastated. In India, within the jewelry trading hub of Rajkot, 44 firms have declared bankruptcy in the past week, exposing $425 million in losses. Multi-generational family businesses in the silver trade have been wiped out. In London, 2 hedge funds have suspended investor redemptions. They cannot return capital because their silver positions are underwater and they cannot sell. In Dubai, physical silver premiums have spiked to 15% over the spot price, as dealers cannot source sufficient metal to meet demand. This crash is creating wreckage across the entire global financial system, and we are only a few days into the event. Now, connect the dots. A 5-year supply deficit, exploding industrial demand, China restricting exports, and the price is crashing. This sequence only becomes coherent if the paper price is being manipulated downward ahead of the March delivery deadline. I believe physical reality will prevail. I believe it always does. Paper promises can be printed indefinitely. Metal cannot. But presently, paper is winning. Gold at 4,500, silver at 72. Longs are being decimated. So what comes next? Where does this crash conclude? No one can provide an exact bottom. Anyone professing certainty is being dishonest. I will not offer specific price targets because, in a crash of this magnitude, technical support levels shatter like glass. Instead, I can guide you on what to monitor. Not price points, but something far more significant. The signals that indicate whether this event is concluding or intensifying. Here is what leads me to believe this is not the final chapter, and this is vital. The Shanghai premium is not collapsing alongside paper. Physical buyers continue to pay $100 while paper trades at $72. If this were a genuine crash driven by fundamentals, physical prices would be crashing in parallel. They are not. Physical is holding firm. This tells you everything you need to discern between reality and illusion. Lease rates have soared to 10%, 20 times higher than normal. Institutions are desperate to borrow physical metal. You do not pay a 10% premium to borrow a commodity you believe will decline in price. You pay 10% because you need it immediately, and it is scarcely available anywhere. The vault drain persists. Smart money continues to take physical delivery. 33 million ounces last week, likely more this week. While retail traders panic and sell paper, institutions are backing up trucks. They are extracting metal from the system. March open interest remains elevated. Despite the crash, despite the margin hikes, despite everything, traders are still holding March contracts. They still intend to take delivery. They have not surrendered. The underlying fundamentals have not altered in the slightest. The deficit remains real. The shortage remains real. China's export restrictions remain in effect. Industrial demand grows with each passing day. The only element that has changed is the paper price, solely the paper price, driven downward through 8 margin hikes and cascading forced liquidations. Eventually, the paper market must reconcile with the physical market. It always does. Throughout history, without exception, physical reality triumphs. The only uncertainties are the extent of the interim damage, the number of traders wiped out, and how low the paper price will be driven before the manipulation fractures. I am convinced physical will win. It always does. Paper can be printed infinitely, metal cannot. This truth has held for 5,000 years, but here is what the panicking retail crowd fails to grasp. Crashes do not destroy wealth, they transfer it. On Friday, wealth was transferred from retail traders to banking institutions. When this situation reverses, that wealth will move back. The pivotal question is which side of that transfer you will be on when it occurs. Paper at $72, physical at $100. That gap will close eventually. Someone will profit enormously when it does. Here is what I am monitoring. These metrics will signal what happens next. The Shanghai premium, currently $28. This is the ultimate truth teller, quantifying the chasm between paper valuation and the price physical buyers are willing to pay. If this gap widens to $40, the paper market is losing all credibility. If it narrows because physical prices begin to drop, the manipulation thesis may be flawed. But if it narrows because the paper price rallies to meet the physical price, that is your signal the dynamic is shifting. This premium reveals everything. COMEX vault levels. Data is released every Friday. Last week, 33 million ounces departed. If another 20-30 million ounces exit this week, the vault will be nearly barren before March. Who is taking this metal? Where is it going? Why are institutions expending resources to move physical silver while its paper price crashes? They possess knowledge the broader market lacks. Lease rates currently 8–10%. The norm is 0.5%. This is the premium paid to borrow physical silver. When lease rates spike to these levels, it signifies acute physical scarcity. The last two instances were 1980 and 2011. Significant events followed both. March open interest. How many contracts remain open for March delivery? If traders are capitulating, open interest will decline. If they are holding firm despite the pain, it stays elevated. High open interest approaching first notice day translates to intense delivery pressure, exactly what the exchanges aim to circumvent. Trading halts and platform freezes. If more funds are suspended, if more platforms malfunction, if more traders report being locked out, it indicates a system under profound stress. Functional markets do not freeze. Stressed and failing markets do. Shanghai premium, vault levels, lease rates, March open interest, system integrity. Track these. The data will reveal the unfolding narrative before the mainstream comprehends it. A widening Shanghai premium means paper is losing credibility. Spiking lease rates mean institutions cannot locate metal. Platform freezes mean the system is fracturing. These are not mere numbers. They are flashing warning lights. Here is the essential understanding I want you to take from what you are witnessing. This crash is not random. It is not standard market behavior. It is not simple profit-taking after a rally. It is 8 margin hikes in 8 weeks, an unprecedented act. It is the CME and Shanghai coordinating on the same day, adversaries moving in concert. It is unusual options activity the day before the collapse. Someone knew. It is a $28 gulf between paper and physical, a divergence impossible in an efficient market. It is vaults draining at 26% per week, smart money fleeing to physical. It is traders locked out of accounts, unable to exit. It is 44 firms bankrupt in India. It is hedge funds freezing redemptions. It is physical premiums spiking globally. This is not a correction. This is a coordinated assault on long positions, engineered to flush them out before March delivery demands expose the fractional reserve nature of the COMEX. And it is working. The attack is achieving its objective. Longs are being destroyed at this very moment. Gold at 4,500, silver at 72, but the fundamentals endure, unchanged. The shortage is real. The deficit is real. Physical metal trades at $100 while paper trades at $72. Eventually this ends. Paper reconciles with physical. It always does. The pivotal question is whether you will survive until that moment. Can you endure the turmoil? Were your stop losses triggered? Did margin calls force you out? The trader who messaged me on Sunday night did not survive. He was correct in his analysis, yet he was still destroyed.